Every trader's dream is a simple and effective way to make a lot of money from the stock market without having to put in too much effort. In order to achieve this goal, majority of traders scroll through YouTube until they come across some indicators such as MACD or Bollinger Bands. And after a couple of hours, their charts go from looking like this, nice and clean, to this. Bunch of random trend lines, EMA, VWAP, and even MACD. A lot of things that are just unnecessary and not needed if you want to be a successful trader. Now, I'm not saying that there's anything wrong with using indicators. However, sometimes you can overdo it a bit. A lot of high-level traders also use indicators. You have people like Humble Trader who use only the VWAP and the volume, a very minimal indicator set, while you also have people like Ricky who use the EMA, the MA, the RSI, the MACD, and the volume. So there's a lot of difference in what indicators people use. However, it's important to make sure that you don't overdo it. So while you might be tempted looking at big traders like Humble Trader or Ricky Gutierrez using indicators in their daily trading, you might be looking to load your chart up with a bunch of indicators. However, it's important to remember that these traders do not just rely on indicators to decide their trades. They know how to properly trade, analyze volume and price action in order to help them make their trading decision. Indicators are just another thing that they use to help make their trading decision. So indicators would account for around 10 to 20% of their trading, not even close to 100%. So when you're going into trading and looking to implement indicators into your daily trading, you have to remember that you can just use indicators to help make your decisions, but not entirely decide them. Or else you're going to end up trying to rely too much on indicators and you're going to end up losing a lot of money. So the reason that indicators are not entirely reliable and why you can only use them to decide part of your trade, but you still need a lot of other factors in order to decide if you're actually going to go in on the position, is because, well, indicators at first, they were basically printing money for traders because, well, they were extremely accurate. The MACD crosses, the blue line crosses above the red line in the MACD, and you buy, and then you get out when it crosses below, and on looking at it, it looks like it prints money, right? But the problem with this is that, the reason it's not reliable is that, see, people are gonna not go with everybody else. What people want to do is they want to be earlier than others. So in order to be earlier, instead of buying as it crosses or a bit after it crosses, they're gonna buy before it crosses. They're gonna buy as soon as it starts curving upwards. So in this case, right, where the MACD is currently, the MACD has started to go above, but it has not actually physically crossed above the red line. So a lot of people would have already bought at this time because they think it's about to cross above, so let me just get in early and I can get in before everybody else and make more money. However, this is everybody's thought process. So then some people are entering here, then people want to be before that, so they're entering before and before, until the second it curves even a little bit upwards, people are already entering into a long position, and the second it goes a bit downwards, people are already entering a short position. And this causes indicators to not be that accurate, and it's why you can't rely on them entirely for trading. Now, to finish off the video, I'm going to be showing you guys some of my indicators that I use every day for trading. Starting off, we have the 9 EMA. I will also change this to 200 EMA when I'm trying to see if the stock is in an uptrend or downtrend. Obviously, is in a serious downtrend. So yeah, 200 EMA, great for seeing if stock is uptrend or downtrend. If you're trying to be a really consistent and profitable trader, only enter short trades when the stock is below the 200 EMA, and only enter long trades when the stock is above the 200 EMA. Basically, the logic behind that is if it's in a downtrend, then play the down, and if it's in an uptrend, then play the up. So If it's down, short, going up, then buy, obviously. So that's the strategy between a 200 EMA. However, for a 9 EMA and a 9 SMA, the simple strategy would be EMA crosses below the SMA and you would short, and it crosses above and you would buy. I've seen that this works pretty well, but I'd say do not base your entire trade off of this, as I explained earlier in the video. Then finally, I use the MACD. I can trade using divergence for it, or just the simple blue line, red line technique. So yeah, and I'm gonna be posting a lot more videos about trading tips and how to just become an overall better trader. So yeah, stay tuned for those, and I hope you enjoyed watching. So remember to like and subscribe.